Welcome back, everyone. We're here with episode 2 in a series called Building the Basics. Today we're looking at the MA, which is a moving average. There's a number of them we're going to get into. We're going to try and keep it simple for you. In the first episode in the series, we did RSI, which is our relative strength index. And if you couple that with this one, you're going to find that you're even more in tune to the trading of the day. I got my buddy Aaron over here. I'm Patrick. We are the Double Slit Stock Experiment. Let's get into it. Aaron, what do you think, bud?
So we're talking about the moving average today, and there's a couple different ones that are frequently used. Probably the two biggest are a simple moving average or an exponential moving average.
SMA and EMA.
Yeah, exactly. And the SMA is simply an average of how many ever days you choose. It averages the closing price together and divides it by the amount of time that you choose to have it look at. So if you did a 9-day moving average, it's going to look at the last 9 days, add the closing price together for each day, and then divide by 9, and that gives you the current point on the moving average. The whole point of this is to smooth out the ups and downs in a stock chart so you can see more clearly how a trend is developing rather than where the actual stock price is in that second. The exponential moving average is simply an average that over the same duration of time would give more weight to recent price changes over older price changes. This allows it to respond more quickly to current changes in a stock price compared to a regular SMA, and it gives you some ups and downs by using something like that. But we'll explain a bit more as we take a look at it.
Yeah, let's take a look. Let's take a look at the MA, shall we? Oh, wrong slide there.
That's got too much jack in it.
There we go. I think I got it.
All right, so here's the chart. This is our moving average example here. This is using our Webull app. You'll notice in this top left corner that you have this little blue button, and I'll go ahead and highlight that in yellow for you. You're going to go ahead and click that. That'll bring up this indicator row right along here, and you can see it. It lists different indicators right along there. Once you've selected MA on the bar, you'll get this MA down here on your stock chart. And you can see this little gear. If you press it, which I've indicated in yellow, it'll bring up your moving average screen. So from here, you can actually change how many days each moving average is looking at, and as well as turn on the moving average over here on the side or off, as well as something like the EMA. You'll notice all of that's done here, and here's where you'd select the MA or the EMA. As we continue on, once you've done that, the next key thing to do is click on Style. Style will let you change the colors of the ones you want to display on your chart, and then you have to click these radio buttons here in order for it to display it on your chart. If you don't select it, like these down here at the bottom, it won't display on the chart for you.
Right. There's a legend over here for you, right? That reminds you of what it is.
Correct. So up on the screen, you'll notice here at the top, we've got our MA. We've got the green. It says MA 50, so that's a 50-day moving average. MA 21, that's a 21-day moving average in yellow. The MA 200 is our red line, and that's a 200-day moving average.
You can see how consistent it is. I mean, it's very clear with the 200. I always like to have the 200 there as a reminder that this is usually a long-term game. So when you're trading, that can mean different things. But, you know, are we in a considerable move up or are we moving down? You can always see the overall trend when you back up. The 200 always lets you back up and look at everything.
It's always good to look at any stock you're thinking about investing in at different time frames, just to get an idea whether or not the trend you're looking at is a short-term period, or is it in a long-term trend, or is this just a hiccup?
Right.
So the last thing that you see on here is we have our EMA selected as well, and we're displaying that in purple. The EMA is quicker to react. So you can see from this red candle here on the screen, when the EMA or when the price jumps up here, the EMA jumps quicker than the SMA. And these are both 21-day moving averages. So the EMA jumps up a lot faster and shows you that there's a change happening to the stock.
Right.
And it's showing you that quicker than the SMA does. However, as you continue on, and you can see hold on, let me go ahead and label that. The SMA is slower to react. It's just more of a smoother uptrend where the EMA really popped off there. And as we continue up the line there, you can see at this point in yellow, that's where the last red candle was. It jumps up. It also comes down faster. So that's where the EMA can be helpful, but it can get you into something possibly quicker, but it can also get you out of it faster and sometimes through a false positive. So you can see as we had our uptrend, the EMA came and crossed the SMA as this candle crossed both. But unlike the EMA, the SMA continued on this uptrend and saw the rest of this trend here before it finally dipped below. Where the EMA responded faster, you might have missed out on the remainder of this upclimb.
Mm-hmm. Yep, and I liked how we have on the chart here at the bottom, you can see that we have the RSI pulled up. In conjunction, you can see that it was at the top of that price movement. It says 71 up there. That RSI was, I don't know, looks like it was about 80. I can't see it in the chart at the time, but it's definitely overbought.
It was about 85.
Yeah. So I mean, it's well overbought. You can see what was going to happen. I mean, you can use the indicator on the RSI in conjunction and look at what those moving averages did as well, and when they crossed, and look at the RSI and how that works in conjunction. I think it's really neat. We have the MACD in the center there, and that'll be in the next video. Then that's the three indicators that we typically look at everything with. That's the lens that we use, and the general understanding of all this stuff. It really does put things into a better trading perspective, getting in and getting out. You can use all three of them. Doesn't mean you're going to be right, but it definitely can help you.
The more you look at stuff that you've done, or the more you practice using paper trading, using these indicators, you'll start to notice patterns. You'll start to get a feel for when you feel comfortable getting in and out of a position, or what you deem as your most accurate, sign of that.
I think a great reminder that you just brought up was the paper trading account. For those who just want to start and not put any family money towards it, if you know what I mean, it's always a great idea. And Webull does have that platform as well. You can paper trade just a fictitious amount of money and see what happens with the real market conditions that you'd be using these types of indicators for. And it can be a really good trainer, and you could become pretty decent at it in just a few hours.
So what we're looking at now is a longer time frame to give you a better idea of how these moving averages can be used. So you can see in the main focus of this time frame was to show you our 200-day moving average, which is this red line coming across the screen. Now, as the red line's coming across the screen, that's our 200-day trend. So that's how the price has been moving for the last 200 days. So as you follow our shorter term trend lines, our 21-day moving averages, as they cross below that 200-day moving average, it goes into a downtrend, and as it crosses back above, it goes into an uptrend. And the price strength, or the trend strength, is how far away the price gets from that moving average line. This is a really strong downtrend right here, where it's weaker as it gets closer and closer to that moving average. Same thing over here. It's a bigger uptrend the further away it gets.
And you can see how many times it bounced off that 50 MA on the way back up. We just bounced, found support, dropped below into that 200. Yeah, you're going to go over the reversal. That's good. Yep.
So what we're going to show is the reason we bring this up is to give you an idea how these moving averages could be helpful to you. You can try to use them to give you an idea of when a stock's reversing its trajectory. Right here, you can see it crossed our 21-day moving average, crossed below our 200-day moving average. And so it went into an actual downtrend. If you wanted to wait, if I'm doing a long-term investment, I mean, we can see it entered that downtrend in March, and it didn't really get back above it until around August. So that's quite a few months. If you're in it for the long haul and you buy it and then forget it, like a lot of investors do, then this really isn't going to matter so much to you in a few months span time. It's more how it's performing over the year. Mm-hmm. But yeah, you can see as it moves down below, it has reversed and gone to a downtrend. And then as it continues on, it reverses back up once it crosses the 200 here. And you can see it comes down and tests. And although the stock price made it below the 200-day moving average, our 21-day moving averages did not. So this shows that it did not reverse. It tested that support, or that 200-day as support, and then it continued up. So at this point, it's still in an uptrend.
Mm-hmm.
We go ahead and zoom in a little bit here. I'm going to give you an example of how you can see a shorter term reversal. So this is that same stock chart, but zoomed in a little bit. And you can see if we're doing a shorter duration, our 21-day moving average comes down, and then it crosses above the 50-day moving average. And it finds support, and it continues up. And we can see it stays in this uptrend until the 21 crosses back below the 50. And that's when it starts to dip back down. In this particular case, it did manage to find support and go back up again. However, it could have continued down. Mm-hmm. So for this run right here, we saw a reversal upward once it crossed above the 50-day moving average. And then we saw a reversal downwards once it crossed back below it. So depending on what time frame you're using, you can use different moving averages to try to give you a better idea of how the trend's performing and if potentially it has changed directions.
Yeah, so that's a really good explanation. I think you can go back and take it in if you want. I know that me rewinding through some of these things helps me sometimes. Again, the paper trading is a great account. Webull offers that. And then also, I think something to think about is if you want to get more in depth, if you want to see more about this stuff, we try to keep it simple and short. But if you really want to get involved, we do recommend guys like ZipTrader or the Traveling Trader you can search on YouTube. We'll even put the links in the description. No affiliation there. We learned a lot from those guys, and they're brilliant at more in-depth understanding as well. They got courses and things lined out as well. So
I'd just like to thank everybody for taking the time to watch us. We appreciate your time. As the biggest support that I can think of is just giving us your time. So thank you so much for that. We hope to see you again soon.